In 2008, the US economy witnessed one of the worst financial crises, also popularly known as US housing bubble burst. In that financial meltdown, one of US biggest bank, Lehman Brothers, with history of over 100 years, got bankrupt and had to shut down its business. The impact of US housing bubble burst was so severe that over the next 1.5 years, US S&P 500 index that tracks the top 500 companies of US tanked more than 50%. And this financial meltdown created recession in the entire world. Even the Indian stock market witnessed meltdown and Sensex tanked nearly 60%. And now over the last few days, the US financial market is again facing a difficult time. On last Friday, one of the leading US banks named Silicon Valley Bank got collapsed. It was the 16th largest bank of US with a deposit base of nearly $175 billion. That's roughly around 14 lakh crore rupees. That's nearly the deposit size of entire HDFC Bank, which is the largest private bank of India. So you can imagine how crazy it is. In fact, Silicon Valley Bank is not the only bank that has collapsed. There's another New York-based bank named Signature Bank that got collapsed on Sunday. It had a total deposit base of $110 billion, roughly around 8.8 lakh crore. Now, this financial crisis in US has certainly generated multiple doubts. For instance, the biggest question is, what really went wrong? Why did Silicon Valley Bank and Signature Bank collapsed? And then, how bad is the situation as compared to 2008 crisis? And as an investor, the most important question is, how badly can it impact the Indian economy, banking sector in general, and the overall stock market? So in this video, I have tried to cover all these important points. Alright, let's get started. If you look at Silicon Valley Bank, it was established way back in 1983. However, in last few years, it witnessed huge growth. The biggest reason was its support for tech industry. It lended money to startups even when no other bank did. So it started gaining popularity in tech and startup sector, and many VC firms deposited money with Silicon Valley Bank. As a result, in last 2 years, its balance sheet swelled with deposit growing from $60 billion in FY20 to $190 billion in FY22, representing 3x jump in 2 years. And look at the coincidence. Just 5 days before its fall, Silicon Valley Bank was named one of America's best bank, and it even tweeted about it. Now the question is, what is the root cause of Silicon Valley Bank failure? The answer lies in interest rates. Basically, during 2020, US Central Bank dropped the interest rates to near 0%. That resulted in crazy liquidity in the market. That was also the time when tech startup valuations zoomed exponentially. VC firms were funding tech startup left, right and center. This was similar to 2000 dot-com bubble, where if you had just had a website, your firm would be valued in millions. So in 2020 and 21, tech startups received huge money from VC firms who did not even bother about the business model. Now that money had to be kept somewhere, isn't it? So majority of that money was deposited with Silicon Valley Bank. Now if you look at the business model of bank, it takes money from depositors and pay them a fixed rate interest and then lend it to borrowers at higher interest rates. In between, banks keep their margin and that's how they make money. Now in case of Silicon Valley Bank, their deposits grew 3x in 2 years due to crazy inflow of money, but their loan book did not grow that quickly. So obviously that money had to be invested somewhere. So Silicon Valley Bank invested a chunk of that money in US bonds. So far everything was going fine. But remember that when depositors deposit their money, they can always withdraw it. Now what happens is, due to near zero interest rate in US, the inflation shoot up significantly and it broke 40 years of record. To control this inflation, central banks started rising interest rates. This interest rate in US touched a level of 4.5 to 4.75% recently. And that's when the problem started for Silicon Valley Bank. Due to rising interest rate, the money flow started drying up and venture capital funds started pausing their funding spree. Now those startups still had to run their business, isn't it? So they started withdrawing their deposits from Silicon Valley Bank. To meet the withdrawal request, Silicon Valley Bank had to sell its investments in bonds. But the problem was that when it invested in bonds, that time the interest rates were very low. And the catch with bond is that bond prices are inversely proportional to interest rates. So if interest rates increases, bond prices decreases. This is very important to understand. So let's say you invested in a bond worth rupees 100 And let's say at that time the bond yield was 2%. Now when the interest rate increases, the new bonds started offering higher interest rates and the old bonds that are offering lower interest becomes less attractive. So in the rising interest rate scenario, the old bond prices starts falling. It means the bond that you purchased for 100 rupee might be available for say 97-98 rupee. That's a loss of 2-3 rupees. Imagine the situation in billions of dollars. That's what happened with Silicon Valley Bank. To fulfill its commitment for deposit withdrawals, it had to sell its bond at loss. Bank sold $21 billion worth of securities at loss of $1.8 billion to ensure liquidity. Now Silicon Valley Bank was planning to raise capital as per the guidelines to plug those holes. But during the same time, another bank called Silvergate, which was mainly a crypto lender, crashed. And that spooked the investor community and everyone jumped into withdrawing their deposits. Silicon Valley Bank could not handle this crazy demand for withdrawals and got collapsed. For instance, on March 9th, there was a withdrawal request of $42 billion in a single day, which was equivalent to a quarter of bank's total deposit. After that, Silicon Valley Bank share price tanked 60%. Eventually, US regulator had to step in to handle the mess. So that's the story of Silicon Valley Bank. I hope you clearly understand what went wrong. Likewise, another bank called Signature Bank that had nearly $115 billion of deposit got collapsed on Sunday. The reason being that banking system runs on trust. And when that trust is broken by one bank, you start questioning another banks. And out of fear, people rush to withdraw money from other banks too. This created a snowball effect, and that's where the weak branches started falling off. After Silicon Valley Bank collapse, even Uday Kotak tweeted that when interest rate move up 500 basis points from zero in a year, an accident was waiting to happen somewhere. On the other side, the reason for collapse of Signature Bank is A, it had too much exposure in crypto startup, and B, Silicon Valley Bank collapse created panic among Signature Bank depositors that rushed to withdraw their money. So as discussed, the root cause of this problem is interest rates. And that is the biggest concern everyone has. US Fed has clearly mentioned that they are not looking to reduce the interest rate in the near future and the inflation number are still too high. And if this interest rate sustain for long, it is going to badly impact the US economic growth. Now the question is this crisis similar to financial meltdown of 2008? Okay, before we discuss that, we have a partner for this video. It's M-Stock from Mira Asset. M-Stock is disrupting the traditional brokering sector with its unique business model where you can do unlimited trades without any brokerage. You just need to pay a one-time fee of $999 and it includes your free intraday trading, free delivery, free FNO trades, basically everything free for just one-time fee of $999. And if you open a Demat account with M-Stock, you just need to pay a one-time amount of $999 and your Demat maintenance would also be free for life. So basically you pay a total of $1998 and all your trading is free and your Demat maintenance is free for life. In the last 10 months since launch, M-Stock is adding one client every 30 seconds and has added over 1.4 lakh clients with over 6 crore trades. And with 73% active clients and 155 crore of MTF is booked. Also, they have achieved 1 million trades in a single day, which is a big milestone. Since M-Stock is a part of Global Mira Asset Group, it brings 25 years of legacy and experience of 15 countries. So if you are a trader, then M-Stock can save you a lot of money in brokerage, and even for investor, M-Stock is a great alternative trading platform to save money on brokerage. And now you can also start trading using M-Stock e-margin facility that offers one of the lowest interest rate in the range of 7.99 to 9.49%. M-Stock has a very user-friendly interface and the platform is built on advanced technology that provides you with stable platform and a seamless experience. So do check it out. Link is in the description. Now coming back to our question, is this financial crisis similar to financial meltdown of 2008? Well, not really. That was on a different level altogether. This crisis is mainly due to poor business model of Silicon Valley Bank, where it mainly focused on tech sector and poor decision making in terms of managing its capital. So it's more of a business model failure rather than entire banking sector failure. Now going forward, it would be interesting to see if there is more snowball effect left in the US financial sector or will it start recovering from here. At this point, the biggest challenge is that a lot of money of tech companies is stuck with Silicon Valley Bank. And if they can't access it, then they can't pay salaries, can't run the business, basically can't do anything. That is a deadly situation. And as far as deposit insurance is concerned, there's a limit of $250,000, but 85% deposits are more than $250,000. But good news here is that US regulators have ensured that depositors will be able to withdraw their deposits. Let's see how things unfold in the near future. After the news of Silicon Valley Bank fall over the weekend, the global markets have tanked and even the Indian stock market is on downward trend. The pressure is more on Indian banks. Now the question is, will this Silicon Valley Bank collapse really impact the Indian banking system? Thankfully, the Indian banking system is much more resilient today than ever before. The net NPAs in banking sector are at multi-year low and the credit cycle in India has just started. So fundamentally, Indian banking system is in a much better position. It means this correction in the market has only made the Indian banking sector more attractive. But there is one bank in India that got into trouble after Silicon Valley Bank collapse. The bank name is SVC. So it's a Mumbai-based cooperative bank, but it got into trouble just because its name sounded similar to SVB. So it had to release a statement clarifying that it has no connection with Silicon Valley Bank. Anyways, so this is the update on Silicon Valley Bank collapse and my take on the entire development. I'll keep an eye on this issue, and if there is any major development, I'll keep you posted. For now, it's a good discount season for long-term investors to buy quality stuff at good levels. So I hope you all are utilizing this opportunity, but in a systematic manner. I hope you'll find this analysis useful. If yes, there is a like and share button. Now tell me, what is your take on this collapse? Are you utilizing this correction to invest more or still worried about what is going on in the market? I'll see you in the next video. Till then, take care.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.